Good morning. This is Connor from 0DTE Traders here to present the week ahead for June 9th, 2025. Let's dive in. This week, markets will be closely watching trade developments and key inflation data. Today, Monday, U.S. and Chinese officials are scheduled to meet in London. The previous round of trade talks produced a surprise trade truce that lifted market sentiment, raising the expectations for this meeting. Be prepared for market moving headlines this afternoon and throughout the week. On the economic front, CPI due out Tuesday, PPI due out Wednesday, offering fresh insight into the inflation trends. On the earnings calendar, highlights include GameStop, Oracle, Adobe. Also, Apple's WWDC 2025 conference kicks off today. The SPX Gamma Index, which measures dealer gamma exposure, stands positive, 560 million notional. Bulls remain in control. The SPX flip, however, has shifted higher from 5,900 last week to 5,975. So that transition level getting closer to the spot price. This is our risk off transition. So a break below could present some momentum opportunities, a bit in volatility as dealers transition from stabilizing to destabilizing, i.e., selling weakness, buying strength. So that would negate to some extent the buy the dip trade. That transition, 59.75, you can see here on the notional gamma chart, all strikes above positive, that is supportive for the market price. Most strikes below negative, that is destabilizing for the market price. 59.05, however, is positive. This is the JP Morgan short call strike with the expiration at the end of the month. So if we do get a risk off move this week, that would be potential downside target and perhaps a floor into that expiration. SPY, we don't give a lot of weight to the transition, but it's fairly close to the SPX flip at about 59. So 595 SPY, which is about 59.59 SPX equivalent, and same sort of profile here, looking at notional gamma. In terms of the trend, the market's been in a strong uptrend, guided higher by this large macro upsloping trend line originating from April's low. We've had several dip buys off of this over the past couple weeks. As you can see, 1, 2, 3. We did break below it last Thursday, however. This was in response to the Trump-Musk spat on X, although was quickly reclaimed the following day on a strong jobs report. So continues to be in play, could act as support, but we've tested it about 6 or 7 times now. And as we know, the more times we test a level, the more prone it is to break. So along with the flip, this is a potential momentum trigger. So hopefully, we get some good momentum opportunities here this week. And it looks like it could be to the downside if we break those key levels. On the upside, so in terms of the upside target, 6,000 is a big level. There's no doubt about that. We did pin it on Friday. It's our big balanced gamma strike, 6,000. However, that call wall did shift higher, which is simply defined by the strike with the highest net positive gamma. This is regarded as our upper bound. So potential target this week, 6,100 if we get continuation. However, it's not that clear. We do not see confluence with SPY positioning, which their call wall stands at about 600. So we have not seen that shifted higher. So we got SPX 6100, SPY 600, which is equivalent to 6009 SPX. So I think there's kind of a big question mark here. Do we break and hold above? We don't really see confirmation here from the options market at this time. With the VIX pushing into the 16s, there's limited fuel to drive for their upside in equities. As a result, volatility target funds who adjust exposure based on implied vol, realized vol appear exhausted. Additionally, reports indicate systematic strategy CTAs are net sellers in all scenarios. This suggests any continued upside will need to come from fresh bullish positioning. In regards to VIX positioning, this is the open interest chart. Not a lot of put demand below 16. Now, we've been saying for months 16, 17, potential lower bound. Now, just because you're at the lower bound doesn't mean volatility is going to spike. Vol is notorious for basing for an extended period of time at the lower bound before exploding higher. But given where we sit here technically, given the relative cheapness of puts, the asymmetric risk now favors the left tail. Additionally, a number of catalysts here this week that could spark a multi-day rebound in volatility. Now, what's the implication on market price? Further upside in SPX is more likely to manifest as a positive drift, whereas the downside more likely to be explosive. However, bigger picture, we give edge for volatility contraction going into the big quarterly expiration on 6/20. So big open interest here, calls and puts. It is a call weighted cycle, meaning there's more calls expiring than puts, which is generally supportive for the market price. Vol contracts, the decay of those options invoke buy flows, and we hold that view as long as we hold above that 5,900 transition level. Year to date, I'm up $130,000, 86% win rate, nice steady linear upsloping P&L curve. Did go a little parabolic here over the past few months. Had some big winners due to the elevated volatility, and of course, account size is growing, so trading a little bit larger in terms of contract size. Now, we follow a very structured approach in terms of decision making, in terms of risk management, as well as position sizing. So, if you're a struggling 0DTE trader, you want to take your trading to the next level, join the team at 0DTEtraders.com.